Looking at the monthly time frame, you can already see that we're bullish. We're literally consistently creating new all-time highs. After that, the next thing I'm doing is going straight down to the weekly time frame. And on weekly time frame, what I'm trying to derive is the point of interest where I'll be looking for buy opportunities. And already we have a fair value gap resting right here. So right here, once I outline my fair value gap resting right here, the next thing I want to do is I want to align this weekly fair value gap with the lower time frame in order for me to get smaller time frame entries. Now, how do I do this? The weekly time frame is already giving me the point of interest where I want to buy from. When I scale down to daily time frame, I want to see a point of interest around that same area aligning with that weekly time frame. And in this case, you can see that that weekly fair value gap that is right here within this red zone also aligns with a fair value gap on the daily, another fair value gap here on the daily, and we'll also have the candle without wicks. When a candle has no wicks, it means liquidity. It means there's liquidity resting right there, and price could potentially want to come down to run that liquidity. Another example is this one. You can see this one right here, candle without wicks. You can literally outline that area. You can literally outline this area. This candle without wicks is liquidity. Don't be surprised to see price get drawn into that position to wipe out that liquidity. So now you can see the first confluence, weekly fair value gap. Second confluence, the weekly fair value gap aligns with a daily fair value gap, daily candle without wicks. Now we have three confluences. The next thing I do is to scale down to the lower time frame, 4-hour time frame. And on the 4-hour time frame, the same thing that I did on the daily is what I'm going to do on the weekly and on the daily and on the 4-hour. So the very same thing I did on the daily is the same thing I'm going to do on the 4-hour. So what I do is I look for fair value gaps within that same region that aligns with the daily and the weekly fair value gap. And as you can see right here, there's a 4-hour fair value gap, another 4-hour fair value gap right here. So that means if the market should come down into this zone, I'll confidently look for 15 minutes break of structure and I'll look for a buy. Now, before I make up my mind and say, yeah, 15 minutes break of structure is all I'm going to use, I still scale down again to 1-hour time frame. And the reason I'm doing this is because I want to reduce my risk and I want to increase my reward. As you can see, this is the same region, the same zone. And within this same zone, we have this 1-hour fair value gap. I'll make it a different color. I'll make it green. And then we'll also have this 1-hour fair value gap here as well. You can see that right there, 1-hour fair value gap and 1-hour fair value gap. Now, after these two fair value gaps, the only other fair value gaps on 1 hour that I see is down here. And I don't need those ones. I'm only interested in the ones that are very close to the weekly fair value gap. The moment I've outlined those key levels, I now wait for price to mitigate them and break structure on the smaller time frame. Now, because I'm using a 1-hour fair value gap, I'm going to be waiting for a 5 minutes break of structure once price is down here. Once price is down here, I'll be looking for a 5 minutes break of structure and I'll use that to get into the market. Now, as you can see, price came down in there. The next thing I do, I go straight down to the 5 minutes time frame. And on 5 minutes time frame, you can see how we were literally trending to the downside, creating lower highs, lower low, created another lower high, a lower low, a lower high, a lower low, a lower high, and a lower low right here. And as you can see, The market rallied to the upside and broke structure on the smaller time frame. You can see that very clearly. The moment we broke this structure right here, all I do is to look for a retest to buy. Now, waiting for this retest, you can use a fair value gap as your entry. You can look for last down close candle and use it as your entry. For example, this was the last down close candles before rallying to break structure. You can use the last down close candle. You can use the high. Or you can even have multiple entries. You can have your first entry. Let's say, for example, you want to risk 0.3% on this trade. You can say your first entry, you use the high. Place 0.1% on the high. Place 0.1% on the fair value gap. Place another 0.1% at the last down close candles. And the reason for this is just in case, for whatever reason, if the market only taps the high and rallies, you're in the trade, you make profit. Or if the market taps the high and comes deeper to tap the fair value gap, you have to open positions, you're still in profit. And if you're lucky, in this case, the market went straight down into the last down close candle. You can see the last down close candle here. So what I mean by the last down close candle, like the name implies, is simply the last move towards the opposite direction before rallying to break structure. And this is it right here. So if you can't see it on the candlesticks, you can just take it into the line chart. And on the line chart, you can just see this was the last push to the downside before rallying to break structure. And if you just outline that area and then go to the candlesticks, you can see this is the candle. You can now take it to the wicks. And you can see how price went straight into that position and rallied. So here can be your first entry, fair value gap, second entry, last down close candle, third entry. And you can see how price activated those multiple entries and then will rally to the upside. Now, for take profit position, you can literally target a fair value gap. Or you can literally just, in fact, I would just recommend just target a fair value gap, just to keep it simple, because the market is usually attracted to fair value gaps. You can target this fair value gap right there. And you can see if we go to 5 minutes time frame, and let's say this is your first entry here, second entry here, third entry here. All stop losses, resting here. Give it a little room. Don't ever place your stop loss directly below the low. Give it a little room, even if it's 1, 2 to 3 pips below that low, just due to spread or slippage or whatever. Because if you place your stop loss directly below this low, if price should come down close to that low, your broker might just take you out of that trade, even though it hasn't even tapped the low. Your broker can literally just liquidate you and get you out of the trade. So first entry here, second entry, the fair value gap, third entry, the last down close candle. And you target the same position. You can see your third entry already delivered a 1:5. Your second entry delivered a 1:3.4. And your first entry delivered a 1:2.4. So if you do the maths, it's a total of 2 plus 3 plus 5, which is around 1:10 in total. And this is just one setup. One setup. This one setup already delivered a 1:10 risk to reward. You're literally, like, if you're trading, let's say you're trading for example, let's say you're trading $100,000 account and you're risking 0.1 per trade. First entry delivers a 0.2, which is around $200, $250. Second entry 1:3.4, which is around $350. Around, if you add the both, is around 500 or something. And the last entry, the third entry, delivered a 1:5, which is around 500. if you add it all, is around 1,000. If you can make $1,000 a week, just a week, would that be okay for you? If you're on this call and you think making $1,000 a week, and you can literally come into the market and every week you can just look for the same setup, get that $1,000, get out. Would that not be at least enough for you to pay your bills? And then you can now decide to scale if you want to scale. If you can scale it to a bigger account, that's up to you. But for starters, this is literally the foundation that so many people are paying thousands of dollars every single month to get this level of knowledge. And it's just so simplified. In 10 minutes, you can do your analysis, look for your entries, place your limit order, and allow the market to do its thing.